Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. My guest in this episode of the Sustainable Finance Podcast is Marina Severinovsky, Head of Sustainability North America for Schroders Asset Management, a global firm with $887 billion U.S. in assets under management for institutions and individuals around the world. Schroders believes that markets are currently experiencing more than a typical cyclical turning point, but rather a global reset where patterns of the past decade will face a period of adjustment, and that a new regime in policy and market behavior is unfolding, driven by major global themes like decarbonization, deglobalization, and demographic change, all of which investors need to understand if they are to find the best opportunities and safeguard their portfolios. The Schroders team also tells us that sustainability will be key to navigating this new era, to recognize and price trends like the acceleration of responses to climate change or worker scarcity and the human capital investments needed to increase productivity. Today's podcast represents the first of 3 sessions with Schroders. Marina will set out the framework today for the regime shift and the 3Ds trends of decarbonization, deglobalization, and demographic change, and how they are tied to sustainability. Then in the coming months, members of her team will join us for in-depth webcasts to dig more deeply, first into the decarbonization trend, and then into deglobalization and demographic change. Hello, Marina, and welcome to the Sustainable Finance Podcast for the first of 3 sessions with you and the Schroders team this year. We're very excited to have you.
We're very excited to be participating. Thank you, Paul, so much for having me.
Great. Well, Marina, we've been hearing about a shift in the fundamentals that historically guided markets' behavior. Can you tell us about the new forces and trends at play and how long we can expect them to last?
Absolutely. So if we look at the first page that I kind of set out in the presentation around what we talk about, the sort of new regime or regime shift, this is really an operating principle by which we are sort of thinking at Schroders across all of our asset classes, how we're investing, and that this is something that we can expect to go on for the coming decade, right? So it's not sort of a half year or year, scenario, but really is representing sort of trends that can be structural and they can persist for some time. And so we think about kind of what did you do in the past 10 years? You probably want to think about doing the opposite in the next 10 years. The biggest issue around this is the persistence of inflation. And some of these trends that I'm going to talk about are very inflationary trends. The decarbonization journey, the sort of shift to renewable energy at the front end, the sort of investment that's needed, the creation of capacity, these things can be quite inflationary as you sort of build out, again, a new sort of supply chain to be able to deliver energy globally and the associated costs of these sort of new and renewable sources. And then you have deglobalization, and we've obviously been seeing a lot of geopolitical, shift. There's kind of the sort of China, U.S., East-West sort of divides. It plays into a need to sort of reorient supply chains. These things can be very inflationary too, in terms of, again, where fulfillment happens and the costs of doing that. And then there's issues around, again, kind of demographic change in the world and where the young populations are and kind of what's happening with, kind of countries that have much older working populations. So we're going to sort of talk about that a little bit later on in the podcast, and also, as you said, Paul, in some subsequent sessions. But you can see here, I think the kind of framing mechanism is that inflation will continue to be a challenge because all of these things are by their nature inflationary. The cost of labor, the cost of sort of, different supply chains that may be less cost efficient, but will be required in a new paradigm. And then again, the kind of cost of shifting the energy transition. Central banks will have to prioritize that inflation and sort of tackling that inflation. We've already seen, cost of living crises and things like that over the past year. And so that, becomes really important for central banks to deal with. Again, that sort of structural change in supply chains and in energy. And then from a labor perspective, the need to deal with the scarcity of labor by investing in technological innovation, the kind of capex spend that is needed, and then overall just policy volatility. I think we are becoming quite inured, right, and accustomed to the fact that there is a lot of volatility that policymakers are dealing with, and we just expect that to sort of continue as we see some of these trends that again could be decade-long trends manifest over time. So that's the idea behind regime shift. I
Okay.
think I'll end on this point, kind of, you can ask this sort of question, but as obviously I have a bit of a vested interest, I'm the head of sustainability for North America here.
Right.
But as I look at this, it would be very, very hard to imagine understanding this new sort of framework into the future without sort of what we call, sustainability or ESG considerations. And so that's why I wanted to sort of really marry the two and kind of make the argument that the kind of macro environment that we expect over time actually makes it really important. It puts a much finer point on the fact that we have to understand, how our investee companies are operating, from the perspective of these sort of ESG factors that we think about. And so that's, I'd love to sort of obviously discuss that for the rest of our time together.
Sure. So in this new era, you've already described some pretty dramatic shifts and changes from the last decade at least. What are the implications for sustainable investing going into this new period?
Yeah. So again, decarbonization, very much of the ESG wheelhouse, right? Almost exactly kind of right here on point. And so we talk about, what are the implications, right? I mean, this is, very far-reaching action is needed here. The implications are really pronounced in terms of kind of global GDP. If you look here, kind of per capita versus global CO2 emissions per capita, we're talking about really a very strong shift from a kind of a natural trajectory, the current trajectory, to what is needed effectively to get to net zero by 2050. We're trying to reverse in 20 or 30 years the impacts of industrialization, which have played out over several centuries. And we need to do this on a much bigger scale with industries that are now much more interconnected. We talk about kind of supply chain, than they were in the past. So this is clearly going to be massively disruptive to industries and to economies. And so again, a good investor who's thinking about which companies will be able to thrive in this environment, how companies are preparing for this future, is going to have to really need to understand these issues. If we look at the next page, just kind of taking this a bit more broad on kind of the net zero momentum, we're seeing obviously some 130 countries at last sort of count have set a net zero target. The difference, just sort of 2017, just really a handful of years ago, it was kind of less than 20 countries that had done that. We now have 90% of global GDP is covered by some sort of net zero commitment, and companies are starting to come along as well. Again, you've seen kind of a J curve, right? A really, really quick rise with that perspective. Again, for target dates that are kind of in, the mid-century mark. So this is really happening, I think, on the sort of decarbonization side. And then the social, the more kind of demographic shifts, again, if we take a look at one page down, these social implications for companies are really turning into real costs. And so again, as investors, we're interested in the sort of social trend, but we're much more interested when it becomes a financial manifestation for a company. And so we look here at kind of, what has happened, especially with large companies, and Schroders is obviously a very large investor in sort of public equities and credit. And so a lot of it is looking at these large global companies. You know, they've become very important parts of the kind of markets and the kind of global ecosystem in terms of their share of global GDP, their share of employment, and corporate profits. So they really affect the economy in huge ways. And the pressures on these companies have mounted tremendously. We've, are just living through a period of proliferation of regulation, obviously taxation, and then just in general, societal expectations, public mistrust, public expectations of companies. Again, this becomes a question of regulatory risk and also of reputational risk, in addition to kind of operational and investment risks for companies. What do I need to have the license to operate? What do I need to retain the soundness of my brand? What do, again, not just regulators and policymakers, but what do my employees, my customers, my sort of community around me, and then kind of society expect of me in this new world as a corporate actor? We saw, for example, companies kind of, being judged in terms of the decisions they made during the Russia-Ukraine conflict, the companies who were kind of on the ground. We see things like that. Companies are expected to take some kind of stand. You can't just be sort of a neutral actor and say, I'm just here for the economics, right? For kind of, my business. So that social license to operate, that expectation of companies to think about their workers, to think about their impact on society and environment, it's just getting higher and higher. And so I think as we see these broad global trends, as investors, in order to make the right decisions around companies, I think sustainable characteristics or factors are increasingly becoming kind of front and center, along with all the other things that we as active, managers and fundamental investors are focused on. This just becomes very much part of the calculus. I think of how we need to understand businesses, their longevity, the future proofing of their business models, and whether we're comfortable having our clients' assets invested in these companies over the longer horizon. Again, will they be able to sort of like move with these really significant changes in the world, and be able to thrive, in this new environment?
Well, it certainly has been playing out in the U.S. At the political level as well as in financially and in every other way, especially for large companies. So, how does Schroders believe a sustainability lens enhances the view of portfolio risks and opportunities with this type of dynamic going on in the economy?
Thank you. So we put up here kind of our philosophy, right, which we've had in place for a long time, but I think it's almost never more important than now to sort of think about it in this way. Why are we integrating ESG? There are investment risks, right? I've talked about this. We have a kind of the strength and speed of these global shifts that I'm talking about, create risk for companies that end up getting left behind. And so we have to think about, is your business model structurally, going to be successful in an environment where, again, you have a very different demographic environment and kind of how you can, attract and retain workers, in an environment, again, where your supply chains are pressured or have to be shifted. And again, how, the sort of, it's not just for companies in the energy space, it's sort of everybody who's a consumer of energy markets as well. You have to think about the kind of decarbonization journey as well. There are clearly investment opportunities too within all of this. And so it's not just about risk. It's very much about thinking, where can we identify companies where there's an opportunity for them to grow and to be part of the solution and to frankly be innovators, and to be facilitators of change. And then the impact component, I think, is one that, again, becomes really, really important today. And it's not, I don't mean this as sort of impact investing. I talk about capital I, where you're as an investor setting out to have an impact. It's the kind of impact that you're not even thinking about, because nothing lives in a vacuum. And every investment that we take has an impact on the world. Every company has some kind of externalities to the environment, to society, to people. And the more that we live in a reality where, again, policymakers, regulators, broader society, all these stakeholders become very, very conscious of these costs, which is usually costs the companies impose on society, the more companies will be held to account for those costs, again, around those broad themes that I talked about, but also generally. So we really have to think about, again, how those impacts will be priced in the future, and what it will do to company business models and their bottom lines, right? What does it do to their financials, their profitability, if they're being held to bear these costs. So for decarbonization, it's obviously the cost of carbon. And then, on the kind of human capital side, there's obviously costs around what we pay workers, unionization, all of those sorts of things. If the kind of power dynamics shift, towards labor, it just changes the dynamics. It changes the cost structure for companies. And again, we have to make sure we understand how companies are positioned from that perspective. So we do think that thinking about all of these things improves the kind of outcomes for our stakeholders and for shareholders, obviously, our clients. And then obviously a lot of this is not just assessing it. It's also being involved and engaged as an investor in an active owner with companies, engaging with companies, making sure that they themselves are mapping out these risks, these opportunities, these externalities, and thinking about how they're going to position their businesses and make changes in their businesses around these going forward. So again, it enhances, we think, our ability to really understand companies and also be really educated in our engagement with companies so that we can hopefully have a positive effect on them as their shareholders.
After a very challenging year in 2022 in financial markets, let's focus a little bit now on what the importance of sustainability for investing looking forward is.
Yeah, Paul, it's been a very dramatic 18 months. So to your point, I think I put the slide together on kind of 2022 because there were definitely kind of moments, I think, around just sort of skepticism given everything going on in the world. Like, is sustainability still valid? I think everything I've been saying suggests that it's more valid than ever, but it's also maturing. Our head of sustainability, Andy Howard, in London recently positioned this in a report that's been published as sort of, you know, it, sustainable investing has hit like a 16-year mark, roughly. It was kind of in the early 2000s that you had the concept of sustainable investing as a style, and now it's sort of hit maturity. It's in its sort of adolescence, and it's sort of again kind of hitting that 16-year mark. And it's a rocky period. It's a period of sort of change, and we see this from a number of places. You mentioned obviously politicization in the U.S. We had the sort of Texas, for example, targeting investors that they feel are boycotting fossil fuels, not literally boycotting as in I'm not investing in fossil fuels, but more boycotting in the sense of I've made a net zero commitment and I am advocating to these companies that they also should make commitments and that they should prepare for a net zero future. So a combination of kind of climate commitment and engagement being sort of positioned as boycotting. As sort of asking companies to make changes to their business in expectation of sort of future regulation. And then we've seen in other states like Florida a sort of a different approach. It's less sort of fossil fuel focused and just more focused on ESG metrics in general, and saying we don't want you to take these sort of social and other things into account. They're woke and they're kind of liberal. We really just want you to focus on financial materiality and good returns. And in that case, I think the response is absolutely. We look at these things because they're financially material and because we want good returns. And so I think there's kind of ways to resolve, some of that debate, but certainly the debate is there. We see it all the time in the news, and we're heading into the next election cycle for the kind of, the White House, where we expect these issues to be front and center. Then we have, as we already mentioned it at least once, right, the kind of Ukraine war and, energy prices, and I think really crystallizing in everybody's minds the importance of sort of affordable, secure energy production, for the globe, and how we sort of balance that need today, with the need to, again, kind of continue to decarbonize, which I've already described a little bit, that sort of journey. And then finally, from a regulatory standpoint, I referenced it last year as the regulators sort of circling the wagons, both in the US and abroad, really starting to deal with the question of what it means to invest. What is sustainability? How do you define that? How do you disclose on it? Making sure that there is not, greenwashing in the sense of, intentional misleading of customers in order to just sort of sell them things. So there's just a lot, I think, taking place today for us, in the asset management space who have been committed to sustainability for a long time that we have to work through. But it's okay. I think that it's important for this to happen, this maturation, so that we can move forward in a way that can be more aligned, that people understand why we do these things, that they are for investment reasons, that they can feel comfortable that we are disclosing what we do, that it's sensible, and that customers understand what they're getting. All of those things, again, I think are really critical. And the next slide, just to sort of finish on this point, is that notwithstanding all of that sort of happened, the reality is that the trend is the trend. The kind of fundamental importance of sustainability, and I talked about it in the context of regime shift, but even if we think about some of the things here, the interest from clients, the focus from regulators, and then as we think about business and financial drivers, people identifying, it's surveys, right? Kind of identifying global risks over the next 10 years, you can see how significantly this has changed from sort of a 2008 to today, where a lot of these global risks are, in fact, environmental, they're social, certainly over the last kind of year plus, there's been geopolitical as well. But this, I think, is a trend that, again, is sort of set to persist. So notwithstanding some of the dramatics, right, over the last year in the press and kind of, in the kind of politics, I think our need to continue to position for durability and sustainability of business models in our investee companies remains, completely unchanged.
Well, I completely agree with your perspective and with Schroders' perspective on this. In fact, it turns out that Texas is going to be the state that produces more clean energy within a few months now than any other two states in the United States put together, one of those states being California. So let's dig in now to the first of the 3D's trends, and that's decarbonization. In our next Schroders webcast, your colleagues who focus on energy investment and climate engagement will join us to expand on this theme. But as a start, how do you see the momentum and the constraints around decarbonization trends developing?
Yeah, absolutely. So critical. And I think that point about Texas is really important, where we have to realize that, again, we have some politicking out there, but then there's the reality on the ground in terms of what is happening in terms of policy and investment, where the incentives are, where the kind of, the future is going, where, again, people are taking these investments, and then the energy industry itself, kind of where they're moving. And so, look, I mean, at first basis, we just wanted to kind of show this because I think it's just interesting contextually in terms of that focus on transition. The world has been through previous energy transitions from sort of traditional biofuels in the past, to obviously kind of a coal environment, and then from there to sort of oil and gas. And then we see, again, this very rapid, kind of accelerated future of moving into renewables everywhere that kind of traditional oil and gas can be replaced over time. And so I think this is, again, really important to understand that shift is happening, and it's happening everywhere, as you say. I mean, even in the places where you sort of may not be surprised, but there is no surprise. This is, where, again, kind of we're going in the future, and I think will be more economic as well. Think about that from the perspective of kind of the next page, the acceleration that kind of from the IRA, that acceleration of clean energy spending across the country. We think about this very clear link between economic-driven policy and sustainability-related trends, and that will persist for decades. And so the U.S. Inflation Reduction Act, a great example. Of a springboard, right, for capital to move into industries that provide renewable capabilities to scale that energy transition. So kind of understanding the nuances around the viability of new technologies, right? A lot of traditional energy companies are talking about kind of carbon capture in their businesses, as well as the application and kind of realistic timing of the deployment of existing capabilities, hydrogen, for example, and how that sort of, the benefits from new tax incentives, all of those things help us to have a fuller perspective, for these really important considerations around kind of where and when, we want to take positions. And I think, both smaller and lesser known companies, and also kind of larger and well-known companies, including, of course, the traditional energy majors, stand to benefit from this sort of changing environment that's centered around decarbonization. And again, policymakers and regulators creating the right sort of incentive structure for them to drive this trend forward. And again, this feels to us like it really has taken hold.
So now, how are asset managers, Schroders obviously included, responding to the challenge? In other words, how do you balance the speed of transition that you've talked about with ensuring that investments remain viable? You've got a lot of people with a lot of retirement-focused assets under management and institutions that need cash flow, et cetera. What does this mean for investment portfolios?
Absolutely. And again, Schroders comes from this the perspective of being a global, diversified asset manager. And the vast majority of our clients are coming to us for that service. We have an impact arm, we have, a sort of dedicated impact and sustainable strategies that have a different objective, right? Where clients are trying to achieve something different. But the vast majority of clients are looking for a diversified investment to maximize their risk adjusted returns as they move forward for long, long time horizons for their retirements, largely sort of pension money. And so we really have to think about how we manage the trade off. Decarbonizing too slowly is a risk. And then, there's higher physical risks from climate change, higher transition costs. All you're doing is kicking the can down the road. So you'll have those higher costs in the future. But also aggressively decarbonizing is risky too, because it reduces the investment universe in a drastic way. I mean, this kind of concept of just exclusion is not palatable. We're not able to sort of take out whole sectors and industries without really impacting the diversified portfolio and the returns of that portfolio. So that's neither of those things can happen. And so it has to be really the trajectory has to be sensible. If we look at the next page again, how we're dealing with this, right? There are a number of sort of approaches, in effect, right, that asset managers can take around this, and we certainly have a view of kind of what those a bright approach is. And so there's portfolio constraints, right? So I'll talk about that in a moment. But it's effectively setting some kind of finance, kind of emissions constraints at a portfolio level. Then you divest, right, from kind of more carbon intensive areas, et cetera. Then there's kind of portfolio reallocation, kind of moving to less carbon intensive strategies. This again can be problematic because a lot of it is kind of so geographical movement. For example, from emerging markets to developed markets, you might end up you can at the moment kind of glean some benefit, right? If there's sort of a more carbon intensive companies in emerging markets, and in the kind of developed markets, you can move towards low carbon sectors, technology, what have you. But again, it creates a problem in terms of your global geographic diversification. And then there's target-based approaches where, we'll talk about this too, kind of engaging with issuers, to set targets, monitor their plans, effectively say, we're going to engage, we're going to be active owners. The bulk of the solution here comes from existing, companies in our universe, understanding the way that we do, the way that everybody does, that change is coming and how they're going to move forward. I mean, the couple of statistics that I would give you in terms of what limits the flexibility of the earlier options. One of them is the kind of exclusion of sectors. I mean, you have 80% of financed emissions are coming from 20% of our AUM and concentrated in 5 sectors: utilities, oil and gas, resources, we have materials. You can't very well carve those out again of a diversified portfolio, give up those opportunities. And again, really, I mean, if you're trying to deliver market beta. The other problem is, with respect to kind of that reallocation component, is that if you start to exclude laggards in each sector, or if you start to try to move kind of from a geographic perspective, you get quite a lot of bang for your buck initially. So, in other words, if you think about kind of measuring like the share of your equity market that you remove from your investment universe and how that affects the amount of carbon intensity, right, that you remove. You can start out like, hey, let me get rid of some emerging markets assets. Let me get rid of, some oil and gas assets. So it can be quick bang for buck. But it gets harder and harder as you go. You have to start to remove more and more of the investment universe over time because you're ending up obviously with a cleaner universe. And so the kind of impact as you go becomes much more challenging. So this we think is quite a dangerous road to go down. And so what we look at doing, and it's sort of on the next page, we've drawn kind of a normal curve, basically. People ask about carbon offsets, so I'll just say a word about that. But what we say is that we have to use a combination of approaches. And the tools that you have available to you as an asset owner and a manager on behalf of the asset owner to decarbonize is, of course, some measure of divestment and reallocation. And there are going to be some assets that are just so risky over time, stranded asset risk, again, the inability to evolve their business, that, there's there's some, again, tail end. they'll have to be kind of removed from the portfolio, not just because you're trying to decarbonize the portfolio, but because, from the perspective of sort of affecting real world carbon emissions, these are businesses that, again, are not sustainable business models going forward, or durable business models going forward. And then on the more positive side, we talk a lot now about kind of positive climate solutions. I did a panel yesterday on nature and biodiversity and kind of investing in those things, forestry, for example. So, things like getting rid of deforestation in portfolios, healthy forests are, enormous sort of carbon sinks and carbon capture. And so investing in things that can be, again, kind of natural solutions, which are usually more cost effective than technological solutions around decarbonization is going to be really important too. The scale, however, at the moment for these things is very low still, and the size of the challenge is really enormous. And so, although we are working very diligently, I think, as an industry, to try to scale those things up and to build that capacity for kind of climate positive solutions, and it's definitely part of the map of the kind of what we're trying to achieve. Today, the biggest impact that we can have is around engagement, and so that's the big part of the normal curve there. You can see colored in, right? Is we have Schroders, it has $900 billion invested across, largely it's a lot of it is public markets. A lot of our peer, institutions have lots of money in the markets, and so our ability to, engage with, again, the companies that we're invested with, to encourage them, to facilitate, to support them as they are on that same decarbonization journey, is really the kind of critically important piece that we can have. Carbon offsets, I would say, is something that we also, have explored, again, in that kind of, positive climate solutions bucket. Thinking about the kind of projects that one can invest in. It is not meant to be the core solution. It's meant to be kind of an extra layer for things that just cannot be, that you, from a decarbonization standpoint or kind of mitigation standpoint, cannot really be addressed. There's always going to be some needs, or some needs, let's say, for traditional oil and gas that just are not replaceable. And so from that perspective, if you are investing appropriately to offset that carbon, through, again, kind of nature-based projects, that makes a lot of sense as well. But again, it's sort of like an additional piece. The biggest part, I think, the role that we can play as asset managers is that kind of active ownership, that engagement component, to bring that to bear with the kind of broad, diversified global investments that we take.
Yes, I think that the active engagement and focus on nature-based solutions are really two areas where I've been having more and more conversation, both with asset managers and investors and financial advisors, about the need to focus and energy and time and effort in those ways, because they are part of the solutions, at least the decarbonization solutions, for the next 20 to 30 or 40 years. So it's a matter of engagement and working with companies. And some of the political approaches that are being taken are counter to that, but they seem to be, at least in the U.S., being opposed to a certain degree through the judiciary now and legislation in some states. And so I think you're right. We're going to see lots of transition in these ways that will be supportive over the long run, but it's going to be a volatile and very intense and interesting period for the next 10 years or so. Now, This brings us to the next consideration, which is the just transition. So finally, Marina, how are Schroders and other asset management firms considering the just transition and human rights issues as part of this entire process?
Absolutely. And so it's really what you just talked about, Paul, is that these things are challenging. That there's obviously a lot of debate around them and controversy because they're challenging. The transition affects a lot of people. And we have to be sensitive and, I think, empathetic to the fact that change is difficult. It's not just obviously difficult for the companies and their business models. It's difficult for customers. It's difficult for employees, as industries evolve. And so when we think about kind of, again, just transition, it's that element of, trying to ensure that as we work towards that sort of decarbonized future, we're not exacerbating inequalities, we're not creating kind of additional problems. And so, from that perspective, I think at Schroders, first of all, we've been very kind of focused on this for some time, the kind of investing for just transition. We've always thought about stakeholders in general. When we do an analysis of a company, we think about all the kind of stakeholders that are affected, and we always have. So, you see the kind of stakeholder map there. It's employees, suppliers, it's the community, right? It's your customers. All of those folks matter. And so when we talk to a company, when we engage with a company, part of our engagement blueprint around climate transition is to talk to companies and to understand how they're considering and mitigating the impact of that transition on their stakeholders and on wider society. What is the plan for your employee base? I think in some cases, companies, especially in the oil and gas, sector, will say that with some of the kind of embedded skills of their people, can be pivoted, right, to sort of some of the new businesses that they're undertaking. So, what we want to see that companies are thinking about this. And then, kind of from the perspective of funding a just transition, we want to think about creating products that help, kind of move capital towards areas that need support. So I think it's just remembering that human beings, frankly, are always at the center of these things. We want a climate action. We want a more livable and habitable world in the future. Like we want that for ourselves and our kids and their kids, right? And so it's always about people. And so we think about that for the future. But today, there's obviously people who are impacted, are suffering from the physical effects of climate change, people who are suffering from an economic perspective as these industries evolve. And so just making sure, again, from the perspective of our investments, the way we engage with companies, that there is a sensitivity to this, that we don't consider this in a vacuum. And I will say, just kind of as an editorial comment, that I think part of the reason that we have some of the fear mongering that we have in politics today around these issues, around climate, some of the reason that you have some of the controversy is that maybe we haven't done as good a job as we sort of did in more recently, maybe in the past, we should have done a better job of articulating the same thing. Just something as simple as we understand that change is scary, and it's challenging, and that people have to think about their livelihoods and their kind of economic needs for their families, just as they think about the kind of longer term needs, right? Kind of, again, to have a habitable environment. So I think just the articulation of that and saying that we, again, understand that these things have to be mapped together, I think goes a long way just to sort of start with. And so it's good, I would say, that at the last sort of, couple of, the COP conferences, at 27, COP 15, the kind of human question, I think, has become really front and center as we talk about both. And you mentioned sort of, again, nature and biodiversity, and natural capital investing. As we think about those things, we think about land rights and sort of indigenous rights. We think, again, about kind of people in the global south, and how their economies are impacted as again, decarbonization takes place, and how we adjust, for the needs of those individuals. So critically important, really huge topic, just has to be really linked, I think, fully into how we think about decarbonizing the world. Also a good intro to our next couple of topics.
That's right. That's right. That's right on schedule. As we're moving into the final section of our program today, the Schroders team believes that following a trend of increasing connectivity and interdependence of world economies in recent decades, we're now seeing a trend towards deglobalization, as we've been discussing, including protectionism and reshoring of supply chains. Simultaneously, economies are facing worker scarcity, more power accruing to labor, and companies investing in technology to increase productivity. So these are other circumstances and transitions that are underway as well. How is Schroders adapting to these issues?
Yeah, absolutely, right. More complex points. So if we take a look at the slide here on kind of aging demographics and kind of pressures on wages, I mean, I think people are quite familiar with this concept, right? The age dependency ratio, the percent of the working age population. Especially in the developed economies, obviously places, the kind of emerging markets have much less of a problem with this, but especially in the developed economies, we're seeing that kind of a rapidly aging population and the need to sort of, for kind of how many working age workers do we have to support the rest of that population. And then, we have the kind of US, the labor participation rate. We sort of look at that as well, and the kind of the shifts there. We obviously saw the kind of 2020 collapse, and then how has that really been recovering? And what you see is among kind of younger people, you've had fairly fulsome recovery, but that older people haven't sort of come back to work. And it does affect, I mean, ultimately, especially again in older economies, developed economies like the US, that sort of availability of labor certainly is going to affect a lot of things. It's going to affect wages, and it's going to affect, again, that sort of power that accrues to employers versus the power that accrues to labor. And we see this, I think, a lot now in terms of collective action and kind of, workers asking for more because frankly they can. They're a scarcer resource. If we look on the next page, just from the perspective of kind of, globalization, we talked a little bit about inflation earlier on, that a lot of these trends are inflationary. And so, we do see that kind of, core, right, kind of goods, price inflation is high. And again, globalization clearly has contributed to that secular price decline in kind of core goods prices over decades. That was the sort of operating, sort of principle or trend, for many years as the world became smaller, in effect, right, and kind of more globalized, and again, that kind of connectivity of goods production and supply chain. Again, what we're seeing today is that, there's a bit of a reversal in some of those trends, and kind of reshoring and friend shoring and near shoring, and all those sort of trends around thinking about where you produce goods, and wanting to make sure that as we again are living in a much more challenging kind of from a geopolitical perspective world, that you have kind of that security of supply chain. That has a trade-off, obviously, with cost. So that's another area that we have to really keep an eye on. And if we look at the final slide, kind of going back to that kind of wage component, it obviously affects companies. That's at the end of the day, right? We really have to think about how those higher costs of production and supply chain, and those higher costs of wage growth are going to affect corporate profits. So there's a number of things that companies have to do to kind of raise productivity to maintain margins. And part of that will be, and we talked about CapEx investment, part of that will be investing in technology. So there's many different kind of exciting things there, but part of that is investing in people. And that is, I think, where we have really focused our energy from the kind of sustainability standpoint at Schroders, is how do we think about the treatment of workers, the kind of productivity and stability of your workforce, that, is an social sort of issue, a human capital issue that companies can indeed, we think, affect with good policy. And so we think about that from an ESG perspective.
So, Marina, later this year, your colleagues who focus their research on human rights and human capital will be joining us for a webcast to delve more deeply into these themes. I understand that your team will soon be publishing a key piece of research on measuring the value of human capital management. To give us a preview of this work, can you tell us, how does human capital management create risk as well as opportunity for investors?
Yeah. Opportunity being the important part to get to. Yeah. So this, again, is a really direct relationship to what I just talked about around deglobalization, especially around demographics. If the kind of puzzle, right, becomes there are fewer workers. And so it's really critical that you retain them and that you make sure they're really productive. Like, what do we need to do? And of course, not every company is going to do this right. And so there will be winners and losers. And so first we think about why this matters from a cyclical perspective and kind of a structural perspective. This has tremendous importance. We see rising concern around this on company calls when people are talking, shareholders are talking to companies. Quit rates are still high. Attrition risk, is elevated. As we said, there's from a marginal perspective, workers, are not very unionized. And increasingly, right, that kind of because union membership has been low, the wage premium has been down. But the reality is that kind of there's a focus now on more collective action. So I think companies should expect again that shift towards kind of the power accruing more to their employees. So again, how do you sort of deal with that? We think about this from the kind of human capital perspective of companies will say people are our greatest asset, and then they'll proceed to treat those people like they're just costs. And so they don't really put their money where their mouth is in terms of how they treat people. And in fact, companies rely on different capitals to function. And so, of course, there's financial capital, physical capital, but human capital is, critically important. People are the catalyst that activates otherwise inert forms of tangible capital. People are also an appreciating asset as they work with you longer and they learn more. They're more productive. They're a better asset, and they create economic spillovers through networking and their experience, their knowledge sharing that can either magnify or detract from the returns that you get from those other capitals. And so they're a key stakeholder for most industries, and it's widely talked about. But then, as I said, people are not treated. Accounting sort of talks about just cost. Kind of wages that you pay. And so what we wanted to do was really think about kind of materiality and measurement and kind of management and application of kind of good human capital. And so what we can see from the on the screen there, right, is this kind of mapping. And again, this is just a teaser. There's just quite a lot to this, but it's that kind of companies being again built on all these different human capital systems, and how you think about, again, creating that most effective or kind of rich environment to reduce turnover. And to also make your people most productive. And so you look at that kind of outcomes that we're looking for people, that kind of quality of their jobs, their health and safety, those human systems, the levers you have to pull around innovation, around talent development for people, around their incentives and their management of their performance, culture, massively important, and inclusion, and that kind of operating model and your kind of workforce strategy, all of those things. And so this is what the work that we have done. I mean, it's actually quite calculable. So although I, said the research is to come, and we're going to have another a podcast with you where we're actually going to kind of talk through the research, with the folks who have developed it. But it's really measuring value creation. It's decomposing the return on investment in people in real terms, thinking about again that kind of human capital ROI. And then, what companies really can do, the kind of levers that companies have to improving those human capital returns. Giving practical sort of advice to companies on these are areas where you would want to focus your investments, so that again you're reducing turnover, increasing productivity, and frankly winning. And this what I've laid out is in the demographic shift, this kind of battle for human talent. So very exciting. That's the risk part. The last slide I was going to show is, we already are, even though the research is quite new, and we're looking to embed a lot more of that research into our investing. We're already doing it, and I think that it's pretty nascent still. But the identification of sort of labor factors as things that, at the very least, can mitigate risk, but possibly also can be alpha enhancing, is something that is definitely kind of on the horizon. Again, especially in the context of this demographic shift theme, where you can look at certain key labor themes. Again, you can see them here, kind of different things that reflect whether a company is a leader in terms of how it manages its human capital or whether it's a laggard. You can start to really, I think, scale that. You can start to, give some scoring around it. And it can be one of these factors that you consider alongside other factors in a, kind of when you assess a company, to help you identify the ones that really are kind of, best practices. They're avoiding controversies, and they're, again, retaining their workers in a happier kind of culture, more productive. And that combined with the other sort of CapEx investments they're making in technology and innovation together, again, will give you a better chance of these companies outperforming their peers, and again, really contributing to alpha generation, which of course is right, like what we're really trying to achieve. So I think the opportunity there is really there as well, to understand those risks and actually to benefit from how you understand them, to be able to identify companies that are doing this right, to engage with companies, to encourage them to do this right, because this will be a make or break space, I think, over the next decade for companies, especially in labor intensive businesses.
Well, you've given us an awful lot to think about, and I want to thank you again very much today for joining us as our guest, Marina Severinovsky, Head of Sustainability North America for Schroders Asset Management. And this has been a fascinating start to the conversation that we're going to continue for the remainder of this year, and we look forward to exploring the regime shift and sustainability trends further with Schroders as 2023 continues.
Thank you again, Paul.
Thank you very much again, Marina, for joining us today. And to our followers, join us again next week for another episode. I'm Paul Ellis, and this is the Sustainable Finance Podcast.